Sometimes an idea comes along that doesn't just add a new room to a house. It tears out the entire foundation and changes the blueprint completely. Today, we're talking about one of those moments, an architectural rupture in how we think about finance, all thanks to one person, Eugene Fama. It all boils down to this one huge question. Seriously, for more than 100 years, this was the holy grail for pretty much everyone in finance. Can you actually look at what's happening and know for sure where a stock is going tomorrow? The answer, as it turns out, would change absolutely everything. So to really get how big of a deal this was, you have to kind of travel back in time. Imagine a world of finance without all the crazy computing power we have now. It was less of a hard science and more, well, a collection of old sayings and gut feelings. Things like buy the rumor, sell the news were about as sophisticated as it got.
And hey, don't just take my word for it. Here it is, straight from the man himself. In his Nobel speech, Eugene Fama basically said that when he started, finance wasn't even really a serious research field yet. The whole discipline was just waiting for a big foundational idea to come along.
And then it happened. An idea popped up that didn't just poke holes in the old theories. It completely changed the language everyone was using to even talk about markets. This was the architectural rupture. Okay, so what in the world is a structural rupture? Think of it like this. It's not just a new gadget or a new theory. It's like discovering a whole new law of physics. It rewrites the basic rules, the core assumptions, the entire operating system of a field. It changes how you think.
And the idea that caused this whole earthquake, it was the efficient market hypothesis, a concept that Eugene Fama really ran with. And it was so powerful, it would eventually earn him the nickname, the father of modern finance.
This, right here, is the sentence that turned everything upside down. It sounds so simple, right? In a competitive market, a stock's price already reflects all the known information. But that little idea completely reframed what a market is. It's not just a place to trade. It's a giant, super fast information processing machine. So let's get a little more formal. The efficient market hypothesis, or EMH, says that any new information gets baked into stock prices almost instantly. And that has a huge consequence. It means you can't consistently find undervalued stocks and make a killing. The market, Fama was saying, is just too dang fast. Now, this is where it gets really clever. Fama didn't just throw this big idea out there. He broke it down into 3 testable versions. The weak form says you can't win just by looking at charts. The semi-strong form says you can't win just by reading the news. And the strong form, the most intense version, says even insiders with secret info can't consistently beat the market. This turned a philosophical idea into actual science. But, and this is so important, Fama was also incredibly honest. He pointed out that to test if the market is efficient, you first have to have a model for what a correct price should even be. So if your test doesn't work out, you're stuck with a puzzle. Is the market broken, or is your model just wrong? That's the famous joint hypothesis problem, and it's a ghost that still haunts finance today. Okay, so you've got this amazing new framework, but how do you actually see it? How could Fama and his colleagues really prove that markets were these incredible information sponges? Well, the logic is actually pretty beautiful. If a price already reflects everything we know, then the only thing that should make it move is new information. And what is new information? It's a surprise. By definition, you can't predict surprises. So, if you can't predict the news, you can't predict how prices will change. They follow what's called a random walk. And this is where the rubber met the road. Theory's great, but you need data. In this groundbreaking 1969 study, Fama's team created something called the event study. They looked at something simple, a company announcing a stock split. And what they found was wild. The market reacted instantly, like bam, to the news. But after that initial reaction, nothing. No predictable patterns. The information was absorbed, priced in, and the market moved on, just like the theory said it would. And right here is where this academic idea blows the doors off the university and completely reshapes the real world. It didn't just stay in papers and textbooks. It sparked a full-blown revolution in how millions of us invest our money. I mean, think about it. If the EMH is right, and all the information is already in the price, then what's the point of paying some high-priced manager a ton of money to find winner stocks? On average, they just can't beat the market because, well, they are the market. And that single, powerful insight gave birth to an entirely new way of investing, the index fund. Instead of trying to beat the market, you just buy the market, all of it. And the idea was a monster success. By 2012, we're talking over $3.6 trillion in these kinds of funds, a whole industry built on Fama's idea.
So Fama's work basically created this massive fork in the road for every investor. Before him, the only real option was active management, paying high fees to a manager who's trying to find a needle in a haystack. But after him, passive indexing gave us a totally different choice. Why not just buy the whole haystack for way, way less money?
But here's the thing about a rupture like this. It's not the end of the story. In fact, it was the beginning of a whole new one. It created this huge new debate that's still raging at the frontiers of finance today. And in what has to be one of the best twists of fate in Nobel history, Eugene Fama actually shared his Nobel Prize with Robert Shiller, who is a giant in behavioral finance. So you have Fama, who sees markets as these rational information processing machines. And then you have Shiller, whose work shows how our very human psychology, our fears, our excitement, our biases, can send prices haywire. And that leaves us right here with the biggest question in modern finance. Is the market a cold, calculating machine, or is it just a messy mirror reflecting our own complicated, often irrational human nature? It's a debate that we're only able to have because Eugene Fama created that architectural rupture all those years ago, giving us the language and the tools to even ask the question. And that's a legacy.